Well, this morning I have a great opportunity for all of you to sit and look at just my face for the next little bit because I have AJ back. And AJ, of course, we don't have a face, we only have his voice, but that's good. The voice is, hey, maybe AJ, maybe we're better off not to have your face.
A lot better.
So years ago, I did some radio, and people told me that I had the perfect face for radio. I don't know what they meant by that.
Very flattering.
Very flattering. So, AJ, this morning we wanted to start off talking about the Tesla stock, which has touched at some points on 50% off the all-time high, and which recently has been kind of trading sideways. I guess pretty much this week has been up and down, up and down. What are you seeing right now in the Tesla world? Are you enthusiastic about the future? Are you or do you think there's more pain ahead of us?
Um, so I think the big picture is that um, there were a number of compounding effects, or in other terms, like a kind of a perfect storm. The perfect storm was driven by both an incredible run after the Trump victory, obviously into late December, and then after a stock rallied massively, it becomes increasingly vulnerable. The higher it goes, the higher the risk, the bigger the downside, naturally. And this massive run uh, unluckily coincided with a barrage of constant negative news and a lot of things that were poorly understood, in my view, by the investor community and were compounded by the extreme assault on Elon and by extension on Tesla. This is and if we sort of dive a little bit into, just as a quick recap for everybody who might not be like fully involved in this on a day-to-day basis, like you and me, Randy. Um, so you have to keep in mind Trump was inaugurated, and and then a lot of things happened. There was talk about Greenland takeover, Canada 51st state, and then obviously increasing talk about tariffs, the fallout with Ukraine, or however you want to discuss it. This created a lot of resentment and amongst certain groups of people, and then so there was a lot of political drama, and Elon as the head of Doge, and unveiling all this corruption, fraud, waste, whatever you want to call it, created a lot of, and I think Elon coined it perfectly, antibody reaction. I think this is exactly what we witnessed. And because you have to keep in mind, based on the numbers Doge unveiled, there are literally millions of Americans. It's not a tiny number of a few fat cat millionaires who took money from the government illicitly, but there was a large number of average Americans who, sometimes just because of an accounting error on the government's part, collected possibly for years, maybe in some cases even decades, money they shouldn't have received. And of course, this group mounts, an antibody reaction to this cleansing that's going on right now. So that all this stuff came together. On top of that, there was Tesla delivered like sorry. On top of that, Tesla changed over the main product, the Model Y. We all know this in depth, Randy, of course. But people then looked at the numbers that Tesla delivered and what was reported, and was reported in a completely misleading way. Like, oh, Tesla sales collapse, and then the anti-Elon Tesla people, they were very quick to connect the lower numbers with, oh, Elon's political involvement, and blamed him for all of that, yada yada yada, and portrayed it as if everybody would be abandoning Tesla, which is absolutely not the case. And created or fabricated all this narrative around it, and of course the people who are not deeply involved and may get uneasy about this stuff and get kind of in a panic. And then this created this perfect storm. And Randy, you and I, we know it. Of course, certain people will have used margin. So when the selling started, as this, let's call it what it is, shitstorm started, some people at some point will have been margin called. And I talked to various investors, and I know for a fact this happened. And all this kind of compounded and compounded, and this is why we saw this massive drop. And just real quick on the numbers, you've seen across the board that, oh, numbers in Europe, sales numbers are collapsing in Europe, US is down, China is down. It's all not effing true. Because the reality is the main product that in some regions accounts for over 2/3 of sales, the Model Y, the old one was discontinued. We are moving to the new one, and it's entirely understandable that there is some quite significant number of customers who will not buy the old model just to see their just bought vehicle to become the old vehicle in just 1 month's time when the new one comes out. It's of course very frustrating. You spend a lot of money on a brand new vehicle, and then you see a few weeks later the new one driving by, and you look at your brand new vehicle with a lot of regret. Understandably, people wait for a new product, and that obviously caused then a drop in sales. And then in China, this drop in sales was amplified because the very strong seasonality that it's caused every year, either in January or in February, typically because of Lunar New Year. And then in the US, there's also some seasonal effect, but of course in the US, the political outrage machine is the greatest, because of course in the US there's the most vested interest to lose of what Doge, Elon, and the new administration is doing. And hence, so there is a concerted effort right now, but big picture, this will work itself out in the next couple of months. So I come now to the second part of your question, Randy, about my optimism about the company. And I have to say it's at perhaps the highest level it's been in a long time. And the main reason is, and I said this a million times before, Tesla cannot be about just selling cars. It must be about AI products, because the car business is fundamentally simply not margin rich enough outside of selling Ferraris, that you cannot justify the market cap. So what is driving it is like the AI future, and what makes me very optimistic is that FSD performs now at a level where it's like unbelievably obvious that this system is about to be launched as a ride-hailing network. And I think, of course, we all know this has seen many years of delays. And Elon was in the beginning a little bit maybe too optimistic. It's a very hard problem. But it seems like Tesla is really on track, and there's basically almost on a daily basis, there's more and more evidence that Tesla will hit the announced milestone. And the next big milestone everybody is waiting for is the H1 launch of the ride-hailing network, probably first in Texas, and then very quickly also in the Fremont area. And that will be very exciting. I think when people see Teslas drive around without anyone in them, i.e. when the vehicle is going to pick up a customer, this will blow everyone's whatever off, and will quickly change the narrative. I have seen this many times before. When Tesla launched something that really excited people, you can have very quickly a significant change in sentiment. Right now, sentiment, of course, is very low. I think the share price is always a very good measure of sentiment. Right now, everybody feels depressed. But again, Tesla, you just look at the share price, you can see how it goes up and down. And this is also evidence of how quickly the sentiment can change. And so this was now very. So maybe I stop here for a second to give you a chance, Randy, to react.
So I was curious to know about the feelings. You're in Europe, and do you feel as if talking to individuals that you know that are in Europe, is there is there a huge number, a huge percentage of the population you believe in Europe that will like not buy or might sell their vehicle, or maybe more importantly, might not buy or might sell their stock?
Um, okay, I think the way I look at it is there are a few different groups of let's call it Tesla people in the population. So there is one unchangeable core. They don't care at all about any of that. They are beyond like the media propaganda. They learned their lesson. They learned they were lied to during COVID, etc., and they moved on. So they are not touchable by all this propaganda. And then there is a group amongst these Tesla owners potentially, or people who would have become Tesla owners this year or whatever, and they might have second thoughts and might hesitate, and of course there might be some percentage that says no, I rather pick up a VW or BMW or something, of that nature, because they feel a little uneasy about it. Ultimately, I analyze stuff, so I'm an investor first of everything, before everything, and so ultimately I look at this in relative terms. So first of all, look, okay, what is Europe? Europe is 17% of car sales. So that's not very much. First of all, the entirety of Europe, including the UK, including all the Scandinavian countries, also the one, and also Switzerland. And so it's not that much of market. And then auto sales is not 100% of the Tesla business. There is also energy, which is by far the fastest growing part of the business. And then there is the service and other segment, which is managing of the existing fleet. So in this whole conundrum, Europe isn't all that important. It wants to be important, but it really isn't. And it is increasingly getting a smaller and smaller percent. Why? Because the largest market, China, is just growing much faster. So that's kind of the big picture starting point everybody should be using. And then when you look at what I just said, there are these different groups. So ultimately, we're not talking about 100% collapse of the 17%. No, we are talking maybe about, I don't know, pure guess, 5%, 10% on the 17, on the one that is shrinking. So when you think about it, okay, let's say it's 10%, which I don't believe it will be that much. But let's just assume for a second, just because of political fear and whatever you want to call it, it's 10%. On the global scale, it's still just 1.7% on the low margin auto business. And there's much more lucrative stuff coming down the pipe, and the energy business is already much more profitable. So in relative terms, that 1.7% is on the full business, just the 1.5% in terms of gross profit impact. And that's what ultimately matters. It's even less than that. So overall, I'm not really concerned about the European impact. It's completely blown out of proportion just on a fundamental basis. So that is my view on that part.
So if we look, it's because I want to finish up on Tesla before, and then we want to talk about kind of the overall economy. So overall, how are you seeing the rest of the year? Do you make do you set price targets? I forget whether you set price targets. Are you in my camp where we're looking at potentially 700 or higher by the end of
Yeah.
the year? Yeah.
So the last price target I published, it's a couple of months ago. This was, I said it was 600 plus
Okay.
in 12 months. And at time of publication, that was at the year end 2025. So this is my price target. But the key thing, I want to repeat that because I constantly see people, they forget that. Right now, everybody's worried about 1Q and all the political fallout and the short or medium term effects economically on trades, blah blah blah. But the point is, for a price target in 12 months, 1Q 2025, 2Q 2025, 3Q 2025 make absolutely zero no difference, because in 12 months, at the end of the year, what will be driving the share price is the outlook for 2026.
Right.
That is the key takeaway. That amongst all the noise, all the fear and uncertainty that you hear everywhere, this is what you need to be focused on. Keep the eyes on the ball. And so can there be more short-term pain? Yes, of course there can be. Trump could decide tomorrow to impose 100% tariff on whatever, pick your goods of your choice, and people and markets sell off whatever. But also Trump could decide, okay, I, I got my deal now with country so and so. I take them off the table. This can also happen, and so this will be very interesting to watch. But I think my crystal ball is as good as anyone else at this point, and so we just need to wait and see what happens ultimately, and this will then be probably lead us into the macroeconomic discussion. I'm not sure if you want to go there already or you have more Tesla points.
Okay. So
Otherwise,
you
we could.
so you,
Hmm?
so you so you are still at what you call 600 plus.
Yeah, 600 plus. There will be okay. I get this question a lot. A lot of people are chasing me to update my price target, and I want to explain here again why I haven't. The primary reason is that some of the guidance Tesla provided and some things that I see on the ground, they don't add up in my mind.
Hmm.
And that's why I'm very torn in in terms of how I'm supposed to model this outlook. Because Tesla tells me one thing, but I strongly believe something else will happen, and that's why I'm really torn. And my model is very time consuming, involves a lot of work, so I don't want to produce something that's completely off. So I rather not publish an update than putting something out I don't fully believe in, or something where I have to make too many assumptions. I want to see what's happening in the next few weeks, and then when I have clarity, um, then I'm very happy to produce a sort of an outlook. But right now, I think there are too many moving pieces um, in terms of lower cost product slash product plural. Um, this is there's a lot of new information, and it's all kind of fuzzy in my mind in terms of, yeah. Anyways, there's a lot of detail, too much for this sort of video, but bottom line is it's not as clear, but I think 2026 will be very strong. There's also, and I think this is also public by now, there's strong signal from the supply chain that 2026 will be very good, and ultimately 2026 drives my price target, and that's why I still feel quite comfortable with the number that I put out a few months ago.
All right. That sounds really, really similar to where I am. I feel a high degree of confidence that there is a Model Q. It's not just a stripped down. It's not what I call now the Mexican Model Y. I think it's coming, and it'll be a shock if it's not. That's I guess the biggest concern for me would be if it doesn't come. Not so much if it does, because
Um,
I
Uh,
think.
Sorry to interrupt you, but really, I think I personally I feel basically no doubt, and for the following reason. Elon told us confidently with no qualifiers, maybe, perhaps, or something like that, or might. No, he said confidently in January, which is not long ago, H1 production launch, still on track. Then just very recently, we got interviews with Tesla executives. They also appeared confident it's coming. So if there was a production delay, they at least would not have unprompted mentioned it.
Yeah.
I'd like to point out. So there's a lot of kind of breadcrumbs floating around. The one thing that I find wild is it's now, March, mid-March, and we still have not seen any leaks.
Yeah.
And I said this before, I believe it's impossible to pull off a product launch without any leaks. However, and I said this before too, if Tesla somehow magically does pull it off, the biggest news this year by far to me would be how they pulled this off, because this would mean they reached a level of special ops military operation sort of execution, which is off the charts. Because as far as I know, it has never happened that an automaker pulled off like, I'm not talking about a light refresh. I'm talking like a new platform, like different
Yeah,
form factor,
yeah.
without any leaks. Hasn't happened.
Yeah. All right. Well, that'll be super interesting to see how that plays out over the next couple of months. I guess it's almost I keep telling people that I currently have a hard time watching television because there's so much interesting going on in the real world that
Uh, it,
it makes fiction look boring.
it's funny. It's funny that you say that, because yesterday I never thought this before, but I was scrolling X, and I thought to myself, it's like watching kind of a movie what unravels on X, like
Yeah.
an ongoing like reality show.
Yes, and certainly nothing has created more of a reality show than the combination of Elon Musk and Trump in DC. So what is on your mind this morning? We see this will be showing at 7:45 on Friday night. So, but we're recording it at 5:55 California time on Friday morning. The pre-market is up nicely. Tesla is up nicely so far. But what are you thinking about this morning as about the overall market, about the worldwide economy, but maybe in particular the U.S. economy? What's top of mind for you right now?
Um, it's so at the top of my mind is how the new administration will balance the reduction of the excess money in the system that was purely based on fluff, i.e., debt. That money has to come out. That propped up a lot of key macroeconomic metrics for basically a few years now. So all the labor numbers that you saw, all the GDP numbers, they were basically fudged by the debt in many ways. I know some economists will right now cry or shout and disagree with me, but ultimately a lot of it was built on fluff, and so now as the excess spending and comes out of the system or has to come out of the system in order to get the deficit under control, and by extension, of course, the I mean big picture, it's not the deficit, it's the prospect of creating unsustainable debt servicing cost. That is the big one. And on the second tier, you have the deficit and you have the amount of debt. These are different layers of this main problem. And there are different ways how you can tackle it. Of course, one is you try to reduce your spending. The other one is try to increase your income. And this is how you can tackle your debt problem. And I think, of course, it's obvious the new administration will try to do both. They have to do hard cuts very quickly to get the cost under control, but they also need to somehow manage to get the income growing, and the income is basically trying to get economic growth, because if it's just too much cutting but not enough growth, and even risking recession, a meaningful recession that hits the main road, the big problem is that you might lose the political support that you need to push through these necessary reforms. So what this ultimately translates into is like a fine balancing act. It might look rough on the outside, especially in the beginning, and I talked about this before. I think it was obvious that you need to do quick and hard kitchen sinking, uh, as long as you have like let's call it the launch bonus. Trump just got into office. A lot of people are very euphoric about the prospects, and give him of course, a lot of upfront credit, and they should be, and just want to see, okay, what can he do in his administration of a lot of great people, and but this obviously will take time. And so there's right now this phase of very hard cuts, and this creates increasing amounts of uncertainty, and the administration has to now balance the effects on the economy, because at some point, especially with all this propaganda. If the consumer, and the consumer is the most important entity in U.S. economy, everybody knows the U.S. economy is the most consumer-based large economy on the planet by mile, by a huge margin. And so you need to make sure the consumer isn't losing confidence. Otherwise, you get into really deep trouble. And then your political support may go away. And time flies. And the midterms, they're in terms of macroeconomic picture, they are just around the corner. So, and if you play it right, what you want to do is you want to design sort of a trajectory that you have like a good upward trend towards the midterms, and probably, and I talked about this before, the Doge dividend, or and especially also the tax cut that is on the table. Strategically, the most sense it makes, closer obviously to the midterms. You don't want to do it, right the day before, because it's awful optics. But you want to score these points, so you that can lift you into the midterm, to make sure you don't become like you lose the house. The problem is, if you if you try, even though you try to do the right thing for the country, if you lose the political support before you can execute on it, you still lost, and you haven't achieved anything. So, and that's why I think, and I'm sure the people in White House are painfully aware of all of that. So they try to manufacture this balancing, and it will be very difficult. But overall, I tend to be very optimistic, and I think the election outcome was for me just more proof. Do never write off the Americans. They're always good for a surprise. And that's what I love about the Americans. And therefore, so I'm overall optimistic. However, because there is a lot of excess in the system, that has to come out, and there will be some pain. But I think the step to more pain, markets more down, is not necessarily true. There have been oftentimes periods in the financial markets where there was objectively a lot of economic weakness, but the market already looked beyond that, because even though it's like a ballistic curve upside down. It's like when you shoot a cannonball, it goes up, but there's a certain peak, and then it comes down. And if you now turn this curve around, it's the same with some economic pain. When you do painful reforms, okay, it keeps going down, but we can already see there will be the inflection point, and it comes back up again. And this is often how markets operate. They very quickly price in the downturn. But then once this is priced in, and sometimes this happens abruptly, like within 1 or 2 weeks. For example, COVID was such a case. In the COVID 1Q 2020 sell-off, I think within, from memory, 3-4 weeks, the entire sell-off was priced in, and then the market kept just going up. So, and I don't know. If I knew, I would be trillionaire by now, but maybe we have already seen that main sell-off, or there is more pain to come. But I've studied the recessions in my lifetime a lot, and those were the dot-com bubble, the great financial crisis from 07 to 09, and then of course the COVID crash. There was some European debt crisis, but US investors didn't care too much about that a few years ago, so I skipped that one. But the bottom line is, there. I think the setup right now is a very different one. For example, as a very quick recap, in the dot-com bubble around 2000, a lot of new internet companies, startups with basically no revenue, no income, they traded at PEs 3, 4, 500 times, completely ludicrous numbers, and that bubble then bursted. Everybody knows, and then we went through like a painful readjustment period. But one lesson you could take away from that is, even if you bought at the peak good companies, after just a few years, you got all your money back, and if you stuck with them, you made 10x, 15x your money. And the best examples is, for example, Amazon. Amazon was fantastic hold, and and some of the other obviously very successful company. We don't need to go into detail. There was the dot-com bubble, and then in the great financial crisis, this was also a completely different setup because the global financial system was full with toxic papers that led to the bankruptcy of hundreds of banks globally. And I was in the midst of it because I worked in the FIG group. And so I had firsthand experience how all this went down. And large financial conglomerates like Fortis in Europe, ABN AMRO, huge bank in Europe, and also in the US, they all went under or had to be broken up. And the name bad bank was invented, where basically banks moved all the bad toxic assets into this bad bank, so people could see the healthy remaining part. And anyway, so there was a huge shit show, a completely different situation from today. So this was like a real threat to the global financial system. We are nowhere near that situation. And then compared to COVID, let's just recap. The world was infected by a virus that led to global shutdowns. This was like a plot. This was like a horror movie plot, like completely. And of course, people were rightfully fearful that this could create some apocalyptic scenario. There was some real risk to that, especially if you listen to all the experts that told you, "Oh my God, you have to stay home," blah blah blah. And then when people like me, with economic understanding, they basically project, oh, output drops, inflation, blah, blah, blah. Of course, you sell your position. So this was also a completely different setup. What we see right now is largely driven by investors' worry about the fallout from potential prolonged trade wars. That's ultimately what it boils down to. But this is not driven by a virus or a collapse of the global financial system, or toxic, or hundreds of billions of toxic paper in the system like in the financial crisis, or sky high valuation like in dot-com. No, this is driven by decisions of individuals, and these individuals can turn on a dime once they have a deal that is acceptable to them. And this is something very important to keep in mind. This is manageable, while the other stuff was partially out of control, as for example the collapse of Lehman, which was like almost at the level of Goldman, collapsed in 2008, demonstrated.
Right. So the other side of this is that the market pullback that we're experiencing right now is only at a correction stage. It's normal to have corrections every couple
Yeah,
of years,
good
and
point.
the PE on the S&P was almost the highest it's ever been. It wasn't a shock. It wasn't a, in fact, I've been predicting this correction for about 6 months, but I was really early. I kept saying, well, I think the correction will be next month, but it took longer than I thought. So this was no surprise. Now, if we go down another 10%, if we go full bear, that would be, I think, less expected on my expectations. But what do you think?
Mm,
Do you think we test a full bear at this point?
I think there are a couple of things to unpack here. Um, One, we did see the PE before the sell-off already kind of come down slightly. I think the peak was kind of towards the end of last year, but it was already before the sell-off or normalization. And that was driven because of most companies beating expectations. So then, of course, people adjusted the outlook, blah, blah. EPS increased, hence the PE came down a bit. But the PE on the S&P 500 has become increasingly, I don't want to say relevant. It's still a very important metric, no doubt about it. But the bifurcation into the super mega caps, um, uh, Microsoft, Apple, Amazon, Nvidia, Alphabet, Meta, has created like this subset of the S&P 500, which is a massive needle mover. And then you have the rest, or let's call, you have the middle, and then the bottom.
Right.
And there's also some other heavy weights, you could say, I don't know, Adobe, Dell, um, and a bunch of others,
Sure.
Oracle, there's some very large, Tesla, of course, some very large multi-hundred, multi-cap companies in the mix. But bottom line is, this class of this is new. So when you look at a long time series analysis, this is kind of a new phenomenon. So if you look at like 30 years or 25 years, you kind of need to adjust for that. So I always find it helpful to look at the S&P, including and excluding these top companies, to get like and there are very different technical things you can do to make it even better. But this goes beyond this video. And but the bottom line is this analysis becomes more and more tricky, because ultimately it's about earnings generation, and the fact is that these very large companies, they did it extremely well. And if I just pick one example, Meta, for example, Meta performed incredibly well, and they're like all-time best performance right now. And so they were already huge 2 years ago, and they just keep going. So and I think a lot of investors, they kind of run out of imagination how big these companies become. And I'd like to remind them that not too long ago, a 1 trillion company was unheard of. Look, if you're a new investor, 2, 3 years in the market, this might be strange to you, but if you're like older and have been in the market for longer, you know what I'm talking about. And now we see companies getting close to 4 trillion. But just keep in mind, even if they don't grow at all, they still grow at the rate of inflation by about 100 billion a year. So the long story short, that we see constantly bigger and bigger companies, like a natural consequence of the growing economy, inflation, and some other factors. So before long, there will be the first 5 trillion company. And then 6, 7, etc. And so you need to kind of open up your aperture a little bit. And for that reason, when we now go back to the topping and trading levels, these companies generate enormous amounts of cash flow. And for that reason, they are actually not trading at crazy multiples. They're not trading at 50, 100 times P ratio. They actually trade at very reasonable multiples, because they're printing money hand over fist. And so if you just look at the numbers, it's apparent. And like all these stellar companies with multi-trillion-dollar market cap, I think right now, from memory, they all trade below 30 times. And so this is incredible. So we're not in like an overvalued territory. And the other thing is, the argument is, and sorry, one point, I'm getting here a little long one, but the point is, when you look at the forecast, there is not a huge amount of AI revenue factor into all of this. This is another factor.
Yeah.
And so despite that, despite the prospect of AI, um, th- there is the point I'm trying to make is, these companies are not overvalued
Right.
at this stage at all. And if you believe that AI will be like a huge boost to the economy, then there's huge upside from the current level. Yeah. Anyway, I stop here for now.
All right, so I think most investors right now, the ones that are paying a lot of attention, like my crowd that listen to this channel, are probably factoring in something for the productivity gains from AI. I'm wondering how you're seeing what I think is Trump's attempt to do a complete international reset, where the U.S. is no longer being the teat for the world, no longer being codependent with the other countries of the world, but rather saying, okay, you guys, you need to be on your own 2 feet now. We're going to have fair and balanced. At least the United States is going to set a situation where we're only going to have trading partners where we have fair and balanced tariffs and trading policies. Do you think this is wise? Do you think it's going to be good for the overall worldwide economy? How do you think this plays out right now? Let's just talk about the short term. How do you think this plays out over the next 12 months?
Um, so, okay, if we first talk about the short term, of course, it rocks the boat, because this is a complete change of the decade-old sort of doctrine. US says, look, Europeans, we protect you. We are buddies. We trade well together. Don't worry. Now a different story. US says, hey, Europeans, you need to pay up. You need to make sure you can protect yourself. Basically, what it comes down to, and it's like a huge change. And of course, change always creates uncertainty and fear in people, even if the change long term turns out to be a good thing. People are naturally, I think, afraid of change, and that creates, volatility in the market. But big picture, my view of this is, um, it was long overdue that somebody would force the Europeans to take care of their protection. I mean, to pay for their own protection, because it's like ridiculous to make yourself completely dependent on another nation, even if it's a close friend of yours. It's still not a smart move. And for that reason, I mean, my view is, if had Europe long moved to like at least 2 or 3% of GDP on military spending, I think it's unlikely we would have seen ever an invasion of Ukraine.
Oh, yeah.
uh, because it would be like a stupid
Yeah.
move if Europe had like also 10,000 tanks and millions of artillery shells. They, if they supply Ukraine, you can't do anything about it. But Europe was basically dry on a lot of stuff, and some stuff they couldn't share, because that would have meant they would have been left with almost nothing. So that was like, and also the artillery shell production, which we learned was very important to the war effort, was like non-existent in Europe. And so anyways, this was like ridiculous, like huge economic pot, Europe. Yes, it's not growing slow, but there's still a lot of wealth in Europe, and basically largely defenseless. So that was like an absurd situation. And to Trump's credit, he did warn the Europeans in his first term, and there's this famous video clip where he warned them, and then they laughed at him.
Yeah.
And but he nailed it. Whether you like Trump or not, you have to give him credit. He totally nailed it. And so I think what he does now, he's not just telling them, he's just forcing them. And if somebody is not listening to you, well, you have to use something a little bit of coercion. And I think it's the right move long term, but of course it creates uncertainty, rocks the boat. But long term, it might actually drive more stability.
Okay. So, but that would also, what about the other side? The economic side is,
Yeah, yeah, sorry. The economic side is a very important one, because, for example, what you see in Europe, for example, Europe, because of the European construct, etc., actually was more disciplined. Not all countries, but a number of countries were more disciplined in terms of spending, especially Germany, the largest economy. But now, in part because of, I mean, already at the start of the war, but now even more so, Germany probably significantly increases its spendings, i.e., they will have a larger deficit, of course. And this spending will not only be in Germany, of course, because modern weapon systems need components from basically all over the world. And this will also benefit the US. And this is an economic driver. This will help the global economy, because I mean, we know from other kind of war times, war actually is very good for the economy, in as long as the production is not destroyed. But it's basically good for the economy. And Germany now is spending more money on military than in, I don't know, I can remember. And so this, and also other European countries. So basically the whole of Europe. And if you take Britain in, etc., we're talking about 500 million people with a relatively high median GDP. So there's a lot of economic force once this bloc decides, okay, we want to spend more on military, which is basically pure incremental spending. And some of it, of course, will end up in the US. So overall, this is probably a smart military, a smart policy. A lot of people will disagree, but I think if there is not only a strong US, but also a strong Europe, that will make the world probably a safer place.
So I've come to the conclusion I'm not let's say that my entire career, like yours, has not been spent analyzing markets, although I've always been extremely interested in it from the standpoint of my study of the small businesses, which make up 60% of the U.S. economy. That's where my emphasis has been, and also having run, owned, founded, and run about 40 small businesses. But over the last 2 or 3 years, as I become very concentrated on trying to get my arms around economies, the one that is, at least right now, it appears, driving everything is the Treasury bonds. As the bonds go, so goes the market, so goes attitudes. The bond right now, the 10-year Treasury, has been going in the opposite direction of everything that I think it should be doing, given
Yeah.
Doge, given markets, given a slowdown in the economy, which I think has to happen if you take $1 trillion. If your goal is to take $1 trillion out of the government, you have to have a slowdown. You may not go into recession, but you're certainly going to slow down. Given the productivity that's coming from AI, I would think that the Treasury bonds, the 10-year, would be heading towards the 3 handle, and yet it's up again this morning. I'm trying to figure out why this continues. What are you thinking?
Yeah, so the bond market is an interesting one. It looks at first glance, I would say, deceivingly simple, but in reality is actually quite complex. So maybe just for your listeners, as a quick recap, we're talking, and usually the benchmark is typically the 10-year US yield. The yield, technically speaking, is the discount rate at which you have to discount the cash flows of that bond to set the net present value of these cash flows to zero with what it costs you to buy the bond today. So there's a price yield dynamic. So with that, often way, this is like the theoretical simple framework, but then the mechanics become quite complicated because it has to do with obviously demand, supply, and and then then there is the geopolitical layer. There are certain pockets of huge demand, and one very famous one is obviously China. And China used to be a very strong buyer of US bonds, and for reason that became increasingly obvious with the Ukraine war and what happened to Russian assets, um, US assets are likely becoming significantly less attractive to Chinese buyers. So as part of the economic decoupling, there will also be likely sort of a decoupling in terms of Chinese investment in US bonds, and that basically creates an issue for demand because a huge buyer is then basically absent, or even a demand reduction of that huge buyer can have significant impacts on what we see in the yields. And I think one person who explained this very well is Ray Dalio, and he's probably one of the expert in that field. The other one, but who knows a lot about this area, is Bill Gross. But he kind of, I have to say, it's public. He's a weirdo. He's brilliant in bonds, but he's a weirdo. but it's a different story. But these two people probably not, well, are amongst the experts in this field. But long story short, and Ray talked about this. There's a demand problem, and it has to do with the level of debt, because the US debt has become so large, relative to the economy, etc., that the important safe haven status is kind of challenged in certain ways. It's still there, but it's being challenged, and that also factors into this very complicated yield dynamic. And Ray talked about this, I think, not long ago on the All In pod, And basically, the as people grow uneasy about US debt, this creates upward pressure for the yield. I highly simplify what he said. And of course, it makes sense. Why would you seek an asset in which you believe less and less in, and in which you see increasing risks? And this is a direct headwind for, of course, the goal Trump has. Trump, of course, wants to bring the yield down, because when the US rolls over, debt rolls over means when debt becomes due, you typically what happens, you replace it with new debt. So you have to pay 100 billion, you raise another 100 billion. And the problem is, before the inflation cycle, the US benefited, just like many other countries, from ultra low interest rates. So a lot of debt was raised at, let's say, 2.5%. And now this debt is coming due, and now you have to refinance at 4.2%. And again, I'm highly simplifying. There are different
Yep.
durations of these bonds, and again, so people can follow. And but long story short, you replace, so you're not increasing the debt amount, but because you have your new debt is now on a higher cost, your interest expense continues to grow. And the, and the rising interest expense may then actually drive more debt at the now higher cost of debt. And you can see quickly, and you can quickly see how this snowball can quickly get out of control and become too big. And that's why people who have been sort of warning about this for some over 2 years, that this is getting to a point where this can get out of hand very quickly. And this, I think, is also the reason why Elon became so focused on Doge, and even left his companies temporarily for a few months behind a bit, because he knows whatever he does at SpaceX, whatever he does at Tesla, or any of his other companies, it all amounts to absolutely nothing if the US economy sort of goes into deep recession, because we get into a real debt crisis. And nobody who lives right now has ever seen what would happen in that situation. And the best example would be like the great recession in the early 1900s, sorry, 1900, when was it? 1910 or something. Uh, Anyways, a huge share of US population was unemployed, was awful period, and this we need to avoid at all cost.
Right.
Not only Americans, but everyone else, because I guarantee you, if the US economy crashes hard, you won't be safe in Europe, you won't
No.
be safe in Japan, and you won't be safe in China. So everybody has an interest, so this never happens.
Yeah. All right. So if the bond, so there's a lot of fear right now with regard to the overall situation. There's a reduction in Chinese interest in the bonds. What are you foreseeing? I really believe it's the crux. I believe that the bond is really controlling right now. And I know that I'm in good company on that. Do you think that these bond prices come down now in the short term, or do you think they're going to hang up here in these 4.25, four point
Um,
five area?
it's it's a it's a little bit of, okay. I want to say it's a hen egg problem, or slightly circular, but not really. And what I mean by that is, if we see shoots of economic prosperity come through, from red tape cutting, from Trump's drill baby drill, which is a big deal, because if energy prices have been dropping basically almost on a daily basis since
Right.
Trump's inauguration, and we are down below $17 per barrel. If we can stay at this level, and can even get it a little lower, it will take a little bit of time to get through the system, but lower energy costs, lower oil prices, they have a huge deflationary effect. So that is a key puzzle piece here. And should the overall effect, and of course this will take some time, but should we then see some positive effects of that, um, and people then waking up, oh yeah, there's some light at the end of the tunnel, then I see we will see yields coming down. So we need kind of a change in, we basically need to see some proof points that the current economic experiment is working. And people who feel optimistic, euphoric about Trump and great team, Elon, for them it's crystal clear. But then, of course, you have to look at the other side a lot of investors are very skeptical, and I've worked all my life with investors like institutional, and this is a very cynical bunch. This will be the most cynical bunch of people you will ever meet. And anyway, so the bottom line is these people, they need to see some hard stuff. So some data, some positive data has to come through, and then I think we'll see yields come down. I don't see like they come down very quickly, but I think once the inflation has really solidified below the 2% level, or at the 2% level, because by my estimate, I believe we're already below 2% if you strip out all the silly, shelter and that stuff. And I talked about some of the other drivers like car insurance and eggs. Eggs sound silly, but because the price increase was so crazy, it did indeed, I think from memory, add 11 basis points to the inflation print, which is wild. But there are good reasons why this happened, and it's too much detail to go into here. But bottom line is, so the inflation picture looks good, and if we just have a few more data points that support that trend, we might actually see the Fed reducing the cooling of interest rate cut expectations and maybe putting them back on the table. Not saying they will cut immediately, no, but at least them talking about them, and then maybe, I don't know, creating a prospect of perhaps year-end rate cuts, that would already be very helpful.
Hey, AJ, I know that we've run out of time here because the market is now open, and I know that that means that you need to get on to that, and I need to get ready preparing my show for the After the Bell show. So, AJ, thank you for giving us your insights and your analysis. I know people need to follow you on X and subscribe to you on X. You are the only person that I subscribe to on X. No, I'm sorry, Gary Black. You and Gary Black are the only two that I subscribe to, and I highly recommend people subscribe to you. And that would be 𝐒𝐚𝐽, 𝐒𝐚𝐽𝐿OJOH, right?
Yes.
Okay.
Thank you very much for a shout out.
Okay, you bet. Hey, listen, thanks for coming on. We will definitely have you again. Looking forward to the next time already. And again, appreciate so much what you do for the community.
Thanks.
All right. And to all of you out there, as always, it has been great talking to you.